What stands out is that the most important event that morning didn't involve troops, missiles, or airstrikes. It happened in the oil futures market. Let me show you the timeline. At 6:49 a.m. on March 23rd, trading activity on the Chicago Mercantile Exchange suddenly surged. Within 60 seconds, about 6,200 Brent and West Texas Intermediate oil futures contracts were executed. That represents roughly $580 million worth of oil being traded in a single minute. The direction of the trades is what made the moment stand out. Almost every one of those positions was placed expecting oil prices to drop. For that time of day, the activity was extremely unusual. Analysts later confirmed that trading volume at that exact moment was roughly 6 times higher than normal for early morning oil markets. And here's the key detail. When those trades happened, there was no public news explaining them, no official statement, no breaking headline. The market itself appeared calm. Then, 16 minutes later, the explanation arrived. At 7:05 a.m., Donald Trump posted on Truth Social saying the United States and Iran had been having productive discussions and that planned strikes on Iranian energy infrastructure would be paused for 5 days. The financial markets reacted instantly. Oil prices fell sharply, dropping about 14% within minutes. The Dow Jones surged more than 1,000 points. Anyone who had bet on falling oil prices at 6:49 a.m. made a significant profit less than 20 minutes later. That sequence, the trades first, the announcement second, is why economists, lawmakers, and market analysts began raising questions almost immediately. Some have used a very specific term to describe what the data suggests. Insider trading economist Paul Krugman, a Nobel Prize winner, wrote about the situation directly. He argued that if individuals with access to confidential government information use that knowledge to profit in financial markets, there is already a well-known word for that behavior. Krugman said that word is treason. His point wasn't that guilt had been proven. His point was that the pattern is serious enough to demand scrutiny. Krugman also raised a broader concern, whether geopolitical decisions are sometimes communicated or timed in ways that create opportunities for financial gain. A similar concern came from Senator Chris Murphy. Murphy pointed to trading activity in stock index futures, saying approximately $1.5 billion worth of S&P 500 futures were sold shortly before the same announcement. In other words, two major financial markets, oil and equities, experienced large directional bets just minutes before a post that moved both markets dramatically. Murphy summarized the issue with a simple question. Who knew about the announcement ahead of time? To understand why analysts are paying attention, it helps to look at earlier examples. Before the Iran conflict began in late February, unusual betting activity appeared on prediction markets. More than 150 accounts on Polymarket placed wagers predicting a U.S. strike on Iran within a day. Those bets appeared before any official confirmation of military action. Earlier this year, another trader reportedly turned $32,000 into roughly $400,000 by betting on a major geopolitical development in Venezuela shortly before it became public. And when tariff policy shifted in April 2025, lawmakers also pointed out unusual trading activity just before the announcement. Individually, none of these incidents prove misconduct, but together they form a pattern that financial experts say deserves investigation. Market specialists who examined Monday's trading activity say the timing alone raises questions. Energy analyst Tim Skiro confirmed that the spike in trading volume at 6:50 a.m. was far above typical levels for that period of the day. Legal experts in futures markets say sudden bursts of activity right before market-moving announcements are exactly the type of events regulators usually examine. Financial reform advocates also say the situation highlights two possible explanations. The first is coincidence. Traders simply guessed correctly before news broke. The second possibility is that someone had access to information about the announcement before it became public. There is also a wider context that has drawn attention. Some individuals close to the administration have financial interests connected to industries affected by the conflict. For example, Jared Kushner has been raising investment capital from Gulf states involved in the regional crisis. Meanwhile, members of Trump's family have investments in companies involved in defense technology. At the same time, several oversight institutions that normally investigate corruption have been weakened or reduced in size. The Justice Department's Public Integrity Section, originally created to pursue government corruption cases, has reportedly been reduced dramatically. And according to Reuters, a senior enforcement official at the SEC recently stepped down after disagreements about how aggressively the agency should pursue certain investigations. Those developments have led critics to question whether the systems designed to monitor insider trading remain strong enough to address situations involving political power. But beyond the political debate, there is a simpler issue at the center of this story. Financial markets rely on fairness. Every trade has two sides. If someone sells oil futures expecting prices to fall, another investor buys those same contracts expecting prices to rise or remain stable. When markets move dramatically after an announcement, the profits on one side are matched by losses on the other. And the investors on that losing side often include pension funds, retirement accounts, and index funds held by ordinary people. That's why insider trading is treated seriously by regulators. It undermines the idea that markets operate on equal information. So far, no agency has publicly confirmed whether a formal investigation has started. The CME, which runs the exchange where the oil futures were traded, has not announced a review. The CFTC, which oversees commodity markets, is still working through proposed rules related to prediction markets and financial speculation around political events. Meanwhile, platforms like Polymarket and Kalshi, where people can bet on geopolitical outcomes, have expanded rapidly. Combined trading volume on those platforms recently reached more than $18 billion per month, turning them into major financial marketplaces rather than niche websites. That growth has also made them new arenas where unusual betting patterns appear around political decisions. Reports indicate that some traders have made large profits betting on developments related to the Iran conflict. Critics argue these markets could encourage insiders to exploit confidential information. Supporters argue they simply reflect expectations about future events. Either way, their rapid expansion adds a new layer to how political decisions interact with financial speculation. When you step back and look at Monday's timeline, the facts themselves are straightforward. A large volume of oil futures contracts were traded, betting prices would fall. Those trades occurred minutes before a public announcement. The announcement moved global markets dramatically. Those events are documented in financial data. What they mean, whether coincidence or something more serious, is something only a detailed investigation could determine. Because if decisions connected to war or diplomacy are influencing financial trades before the public knows about them, the implications reach far beyond one morning in the oil market. They reach into the credibility of the financial system itself. And until regulators examine what happened at 6:49 a.m. that Monday, the questions surrounding that moment will remain unanswered. If this breakdown helped clarify the story behind the headlines, consider subscribing. Sometimes the biggest developments in a conflict don't happen on the battlefield. They happen quietly in financial markets before most people even start their day.